This is Quent Bilo with a discussion of several remaining topics in Chapter 9, Accounting for Receivables. The primary remaining topic is the two different approaches companies can use to value their accounts receivable current asset. That is, recognizing the accounts on an estimated, non-specific basis that not all of the recorded receivables are expected to be collected. An estimate of the uncollectible amount is populated to an account named Allowance for Doubtful Accounts by credit entries. This credit entry reduces assets on the balance sheet with a corresponding debit entry to a bad debts expense account. Additionally, there are several other topics in Objectives 4 through 9 they'll be covered in this discussion. Again, the primary emphasis of this discussion is the two different approaches to value accounts receivable, the sales approach and the balance sheet approach. Both are acceptable under generally accepted accounting principles. Plus, we'll cover the two topics in the remaining boxes. So the accounting issues we covered will be valuing accounts receivable and disposing of accounts receivable. The valuing accounts receivable means to reduce their overall value through the use of an allowance account. As assets go down, we'll increase an expense which lowers owner's equity on the other side of the accounting equation. Disposing of accounts receivable generally means selling them before their normal maturity to obtain cash sooner rather than later. So the two approaches to valuing accounts receivable fall under the allowance method, not the direct write-off method. The direct write-off method is the only one endorsed by the IRS for use on tax returns. We're discussing the different approaches that can implement the allowance method, using an allowance for doubtful accounts, because the allowance method is the only one that's acceptable or required by generally accepted accounting principles when credit sales are significant and when all credit sales are not collected by a company. Just a reminder that in the allowance method, the three accounts involved are our bad debt expense account, reducing owner's equity as it's increased with debits, an allowance for doubtful accounts, which is a contra asset account on the balance sheet. It modifies the main accounts receivable current asset. So as we drive credits to the allowance account, we are in effect driving down the asset valuation on the left-hand side of the equation. When that occurs, we also reduce the owner's equity category by increasing expenses through debits on the other side of the equation. The two approaches that we'll be looking at involve only the entries in the estimate stage. The estimate stage is when we make an estimate of uncollectibles in the future in a non-specific basis. We don't know which accounts are not going to be collected, but we make a provision or an expense entry for them sooner rather than later to achieve a matching with the current revenues that are booked through sales revenue. Approach one is a one-step approach. It is an income statement approach. It applies a percent estimated to be uncollectible based on current credit sales. Once with the calculation, it simply makes an entry. Debit expense, credit allowance for doubtful accounts. It's a very simple method. The second approach is a balance sheet approach. Again, it's concerned with what's going to be debiting expense, what's going to be crediting the allowance for doubtful accounts. I will refer to that credit to the allowance for doubtful accounts as loading up or increasing it, which reduces the overall asset side. Again, allowance for doubtful accounts modifies the accounts receivable main asset. The balance sheet approach strictly looks at the asset accounts receivable in total, all uncollected receivables, and calculates a estimated balance that will not be collected in the future. But before it makes an adjusting journal entry, it looks at the existing balance in the allowance account to arrive at what the adjusting entry should be. That is, the adjusting entry brings us to the desired ending balance, which is the calculation in the first step. So the balance sheet approach is a two-step approach, first calculating the desired ending balance in the allowance account, and then determining what the value of the journal entry has to be to arrive at that desired ending balance. Each approach gives a different adjusting journal entry. Each approach, as I mentioned, loads up or increases the allowance account differently, and therefore there's different expense debit in the balanced entry. Whatever approach is chosen in the estimate or expense stage, the actual write-off stage is not affected. Actual write-offs are not different. It does not depend upon which approach is taken to load up the allowance account in the estimate stage. The actual write-off is debiting the allowance account, reducing it, and crediting the accounts receivable when a specific account is abandoned. However, I'm not going to demonstrate that actual stage write-off. That was the subject of a separate narration. I just want to point out that the two stages combined, the allowance for doubtful accounts increases in the first estimate stage with credits, and then those credits are used and debited as actual specific accounts that will be abandoned are identified and removed from the main accounts receivable asset. I'd like you to keep a distinction between the actual write-off stage under the allowance method when specific accounts are removed versus the direct write-off method recognized by the IRS for bad debt expense deductions on tax returns. The direct write-off method is different than the actual write-off entries made under the allowance method. They're different because an allowance for doubtful accounts is only used under the allowance method, not the direct write-off IRS method. The IRS method does not do proper matching of expenses. That is, the risk of doing credit sales businesses not collecting on accounts in the future. The IRS does not recognize estimates of that expense in advance. It always waits until the account is abandoned before the bad debt expense is allowed as a deduction on the tax return. But this is a financial accounting course, not an income tax course. So here's the two approaches we'll look at estimating the allowance account. Both of these are generally accepted accounting principles, both GAAP. The percentage of sales method on the left and the percentage of receivables method on the right. The method on the left deals with current credit sales to determine the debit to bad debts expense and the credit to the allowance for doubtful accounts. The method on the right, the percentage of receivables, is a balance sheet approach. It emphasizes balance sheet relationships, that is, total receivables versus what final balance we want in the allowance for doubtful accounts after an analysis is undertaken to estimate what amount of receivables may not be collected in the future. So the first method emphasis on the income statement relationships, sales revenue versus bad debt expense. The second method, percentage of receivables, looks at balance sheet relationships, trying to get a net realizable value for receivables based on a review of all receivables. The accounts receivable are all previous credit sales not yet collected. The other method, percentage of sales, concentrates on current credit sales of the current period. Again, both approaches are all about this estimate, the entry in the estimate stage, debiting bad debt expense, and crediting the allowance for doubtful accounts. So the first approach, percentage of sales. In this approach, management estimates what percent of current credit sales will be uncollectible in the future. This percentage, as noted, is based on past experience. illustration of the percentage of sales approach. Gonzalez Company elects to use this basis. It concludes that 1% of current net credit sales will be uncollectible. If net credit sales for the year 2012 are $800,000, the adjusting entry is as follows. Now, for simplicity purposes, we're just doing a year-end entry. This could be done periodically throughout the year, each quarter. At the end of the period, they'll debit bad debt expense $8,000, which is 1% of the total net credit sales for the period, estimating that this will all be uncollectible, and credit the allowance for doubtful accounts $8,000. The $8,000 credit to the allowance account increases that account with a credit which has the effect of reducing assets. Assets are normally increased with debits. The allowance account brings down the asset value with a credit, just like the debit to bad debts expense, which is an owner equity account on the other side of the equation. That debit to bad debts expense brings down the owner equity category on the right-hand side of the accounting equation. Again, it's important to understand that there's no specific customer in mind when this entry is made. It's done on an estimated basis. It's a general expectation that is estimated as indicated. No specific account is deemed to be abandoned at this point. The entry is made to book expense in the current period to match against current sales revenue entries made during the year. This is a simple one-step approach. It takes the percent of current credit sales, in this case 1%, makes a calculation, makes an entry, as indicated. Here's the effect on the T accounts. This approach emphasizes the matching of expenses with current revenues. The adjustment to the allowance account disregards any existing balance in the allowance for doubtful accounts. So the entry was an $8,000 debit to bad debts expense, $8,000 credit allowance for doubtful accounts. Again, the debit to the expense account reduces owner's equity on the right-hand side of the equation. The credit to the allowance account reduces assets on the left-hand side of the equation. The second approach, percentage of receivables. In this approach, management establishes a percentage relationship between the amount of total receivables and expected losses from uncollectible accounts in the future. The emphasis is totally on the balance sheet relationships, asset contra asset. This approach looks not just to current credit sales, but it does an analysis of the entire universe of uncollected credit sales. That is, the total value of accounts receivable. Some of those receivables may have come from a prior year and not just the current year. This is an aging analysis which is useful for estimating what the total uncollectible amounts be for the total receivable balance. In the first column, we have various customers, TE $600 balance in receivables, and others as indicated. The total accounts receivable for this company is $39,600. An aging analysis looks at how long these receivables have been carried on the books. That is, how long have they been recorded since the initial credit sale. In the not yet due column, most of the receivables are current, $27,000. In the third column, $5,700 are summarized as being 30 days past due. The next column, $3,000, 30 to 60 days past due, etc. The longer an account is past due, the receivable is not collected, the likelihood increases that it will not be totally collected. Hence, the aging report under the percent of receivables approach can categorize various time periods, length of time, uncollected, and apply different estimated percentages of uncollectability to those categories. So the more recent categories have a lower estimated percent than the ones that are far past due. Over 90 days, this company has an estimating 40% of the $1,900 will not be collected. So this approach simply takes the various category estimates times the dollar amounts for those categories to arrive at the total estimated dollar amount that may not be collected. So columns 2, 3, 4, 5, and 6 are added up. They total $2,228 is the estimated uncollectible amount from the total universe of accounts receivable of the $39,600. Step 1. A composite percent may also be applied to this receivable balance method approach. The company could estimate that 5.6x% times the total receivables may not be collected. I've used the same total dollar here just for simplicity's sake. The point is in the receivable approach is to arrive at an amount, the final answer, that is desired as the credit allowance value in the allowance for doubtful accounts. But that amount, $2,220, is not the adjusting journal entry. It's the desired balance calculated for the total allowance account under this approach at a point in time. This is why we have to know the pre-existing balance in the allowance account before we make the journal entry. Under our example here, the previous balance in the allowance account is a credit balance of $528. So let's prepare the entry to get to the desired $2,228 credit balance. Debit, bad debt expense, $1,700. Credit, allowance for doubtful accounts, $1,700. How do we arrive at that? We want a final balance of $2,228 in the allowance account. Opening balance, credit of $528. The difference is the necessary adjustment entry. Debit expense, credit allowance account, $1,700. That is step 2 to determine what the amount of the adjusting journal entry is. It adjusts to the final answer desired that was calculated under step 1. Again, the emphasis in the percent of receivables method is the asset, the total asset on the balance sheet, $39,600 accounts receivable, and what value we want in the contra asset account, the allowance account, representing amounts that will be not collected in the future. In this case, $2,228. So it's the $1,700 adjustment or additional credit in the allowance account that's required in the journal entry. The debit to bad debts expense brings down owner's equity on the right-hand side of the equation, and the credit to the allowance account brings down assets on the left-hand side of the equation. What follows are several miscellaneous topics in this chapter, such as disposing of accounts receivable before maturity, before they are due. Companies may do this for a couple of reasons, as indicated, that the receivables may be the only source of ready cash that they need today and they don't want to wait several days, or the billing and collection efforts are often time-consuming and costly. But as they give up their receivables, as they dispose of them early, they'll pay a price for it. So the sale of receivables is typically done to a finance company or a bank, which is called a factor. So this process is called factoring receivables. The factor buys the receivables from the business, then collects the payments directly from the customers. And typically a commission is charged by the finance or bank, ranging from 1 to 3% of the receivables purchased. Example: Henderson Furniture factors $600,000 receivables to Federal Factors, a finance company. Federal Factors will assess a 2% charge of the amount of receivables sold to them. The journal entry: Henderson debits cash $588,000 in selling the receivables. They recognize a $12,000 service charge expense, 2% of the $600,000, and they have to remove the receivables from their books, credit accounts receivable, $600,000. That brings the asset down. So they've sold the asset early, only collecting $588,000. And then in that exchange, giving up the receivables for cash, they incur an expense of $12,000. Credit card sales. These are recorded the same as cash sales by a company. That is, cash is immediately available to the retailer when a customer uses their credit card. The retailer will pay the card issuer a fee, 2 to 6%, for processing the transaction. Example, Anita purchases $1,000 of compact discs for her restaurant using her Visa First Bank card. First Bank in this case charges a service fee of 3%. So they enter to record this transaction by Karen Kerr Music, the retailer. They'll receive cash, $970. They'll recognize the 3% of the $1,000 sale, $30 as a service charge expense, and will credit sales revenue $1,000. So a $1,000 sale, the retailer only receives $970. The Visa First Bank card company will charge $30 to later collect that receivable from the customer directly. But the merchant accepting the credit card in the sale transaction effectively receives the cash directly minus the service charge fee. Notes receivable. This is a more formal or written promise of a customer to pay a specified amount of money at a definite time. Normal accounts receivable are oral promises. Notes receivable are written promises. Typical use of notes receivable versus accounts receivable is when the customer wants an extended period of time to pay. The retailer may grant that, but will ask for a note receivable to be written. That would include interest expense as well. Notes receivable are also sometimes created in settlement of accounts receivable. A customer can't pay in their normal credit terms, and so they ask for additional time, and the vendor in effect will give up the accounts receivable and create a notes receivable for a longer period of time, but also with interest added. Let's deal with the subject of determining maturity date on notes receivable. The term of a note is expressed in days or months. That is, it's a 90-day note, a 6-month note, or a 1-year note. Let's compute interest on what's earned by the company extending this note receivable to a customer. First of all, it's based on the face value of the note. Secondly, it's based on the interest rate inherent in the document. Interest rates are always expressed as an annual percentage. And then interest is a function of how long the note is outstanding, time in terms of 1 year. In effect, we prorate the annualized interest rate of the note based on the length of time that the note is outstanding to determine our interest that'll have to be paid on it. An example, we've got 3 notes here, a $130 note, a $1,000 note, and a $2,000 note. Different annual rates apply, 18, 15, and 12 respectively, and different time periods. In other words, the $730 note receivable is only for a period of 120 days, 6 months for the second note, and a full year for the third note. 3 separate examples. Let's compute the interest that will be paid by the customer and earned by the merchant allowing this note receivable. So in the first note, we take the face amount of it, $730 times 18%, the annualized rate, and multiply that times 120 over 360 days. Get the fraction of a year to come up with 4360 is the amount of interest earned during that 120-day period. The second note, $1,000 face value times the annualized 15% rate times 6/12, 1/2 of a year, or $75 is applicable on that 6-month note. The final example, a $2,000 note, 12% annualized interest, but the term is 1 year, And so therefore the proration is the full year, or 12% annualized times $2,240 interest earned annually on that note. Recognizing notes receivable, this is an example of a company that had an account receivable that was not paid when due by the Calhoun company. And so Calhoun asked for an extension of 2 months and was granted it, but they'll replace their account receivable with a note receivable. The note receivable will carry interest for the extended time to pay. Entry, notes receivable, $1,000, recognizing the new asset, crediting accounts receivable, giving up the old receivable in place for a written one that'll have interest attached to it. This is the entry that Wilma Company would give on extending terms to the Calhoun Company. The exchange of assets, the note receivable will carry interest when it's paid 2 months down the road. Valuing notes receivable is very similar to valuing accounts receivable. There'd be an estimate of cash realizable value, that is, how much might not be collected, and an allowance for doubtful accounts will be used as a contra asset deduct from notes receivable to value the expected cash to be collected from notes receivable. Again, anytime a merchant extends credit, there's the risk that they will not collect the full amount. So therefore, the allowance method, using an allowance for doubtful accounts, is appropriate to recognize that some future amounts will not be paid. As we see in the offset in establishing the credit to the allowance for doubtful accounts is a debit to bad debt expense. Disposing of notes receivable. Notes not held to their full maturity. Again, there'll be a price to pay for this. The holder, in effect, wants to speed up conversion by selling the note now before maturity. If the maker of the note does pay in full at maturity, there's simply a collection of it and recognizing interest income. The subject of dishonoring a note receivable means that when it does become due, the maker of it does not pay in full. At that point, the note receivable is no longer negotiable. That means that the company holding the note receivable could not sell it to another party. It's defaulted at that point. Let's look at the accounting for first, the honoring a note receivable. Wilder lends Higley $10,000 on June 1st, accepting a 5-month, 9% interest note. Holder presents this note to Higley on November 1st, the collection date, and the entry to record the collection is as follows. Debit cash, $10,375, the face amount plus all the interest earned. Giving up the note receivable with a credit, reducing that asset, and recognizing the difference, $375 as interest revenue. Money has a time value, and extending this by 5 months has earned $375 for the Wilder Company. The interest of $375 is calculated as indicated below. The face amount, $10,000 of the note, times 9% annualized interest, times 5/12. 5 months was the term of the note. 5/12 is the fraction of the year that is applicable, equaling $375, interest earned. Looking back at the term of this note, this 5-month note, it was created on June 1st, due on November 1st, 5 months later. Now this first entry here that we looked at did not recognize any interest revenue in the interim period. If the Wilder Company wanted to publish financial statements on September 30th, a month before the note was due, let's look at the adjusting entry we would make to recognize the fact that time has passed and therefore interest has been earned even though it has not been paid yet, not been received. So this assumption is that the Wilder Company wants to prepare financial statements as of September 30th. 1 month before maturity of that 5-month note. So the appropriate adjusting journal entry by Wolder is 4 months of interest earned as of September 30th. Again, the note was created on June 1st. We want to issue financial statements on September 30th. And so therefore we want to recognize the economic impact of the interest earned, not paid, during that time period. So the interest earned but not received is $300, calculated at 9% of the note face value, $10,000, times 4/12, 4 months. June through September is 4 months, so they earned $300 during this time period. The entry would be debit interest receivable, $300, that's an asset account. Credit interest revenue, $300, a revenue account in the owner equity area. And again, the calculation, face value, $10,000 times 9%, annualized rate, times 4/12, that's the period of time that the note has been held before financial statements will be issued. Why make this entry now? If this entry were not made, we would not be reflecting the fact that the interest is earned, even though not paid, through September. This is an example of an accrual process. We are accruing interest earned before it's received. Wolder is entitled to receive this as of September 30th based on the passage of 4 months of time of the 5-month note. As indicated, the additional interest of $75 earned will be applicable to the month of November. Let's prepare the entry Wolder would make to record the full payment of the note on November 1st, full maturity. Debit cash, $10,375, the face amount plus all of the interest applicable to that 5-month note. Giving up the asset notes receivable with a credit. Giving up the asset interest receivable, $300. That was accrued at the end of September. It's now being paid. But the amount of interest applicable to November will be recognized currently as interest revenue in that month, $75. 1 additional month of interest earned in November. So in the exchange of assets, cash went up $10,375. Notes receivable down $10,000. Interest receivable previously booked down $300. And current month interest earned $75. This is an example of a note receivable being dishonored. That is, at the time of presentment, the Higley Company does not pay Wolder. What entry would be made at the time the note is dishonored? And here we're going to assume that there are no previous accruals of interest. First of all, we'll establish a new accounts receivable in the full amount of what should have been paid on November 1st, $10,375. The full amount of the note receivable plus the full amount of the accrued interest. Notes receivable is removed from the books. It's dishonored. It's not negotiable anymore. And recognizing the full amount of interest revenue of $375 on the note receivable that is dishonored. Again, this is an example of booking. This entry reflects the fact that we did not previously accrue interest revenue. Theoretically, that would have been appropriate. Had that been the case, had we fully accrued interest revenue, we would have been giving up the interest receivable and loading into the accounts receivable account. In any event here, we're giving up the note receivable, establishing a new accounts receivable in the full amount that should have been paid on November 1st by Higley, and asking them to honor that immediately. Here's a subject of analysis of accounts receivable. We can demonstrate through statistics the overall timeliness of customer payments. For example, if annual credit sales were $29 million a year, and if the average account receivable balance was also $29 million, that means that receivables have a very long collection period. We express that in terms of what we call a turnover ratio. In this case here, it's annual credit sales divided by average account receivable balances of $29 million. So it's 1 times per year turnover on accounts receivable. This is a very slow turnover. Let me demonstrate what's going on here in these turnover ratios. Taking this example of $29 million of annual credit sales. So over the course of a year, the company has made sales of $29 million, all credit sales. And let's look at the collection period. We lay that in. Effectively, the amount of sales made on day one is not collected until a year later. Sales made the next month is collected 12 months later. So we can see a very slow process of collection of accounts receivable. The turnover ratio of 1 is indeed a very poor turnover ratio. That translates to an average collection time of 1 year, 365 days. Let's take a look at a more realistic example. In 2009, Cisco Systems had net sales of $29,131,000 for the year. Net credit sales. It had a beginning accounts receivable balance of $3,008,000 and an ending accounts receivable balance of $3,177,000. We want an average of receivables, accounts receivable for the year, so we take the beginning and ending divided by 2, and we'll calculate a turnover ratio as follows. Net credit sales for the year divided by the average net accounts receivable for the year. The turnover ratio is 8.3 times. That is, on average, the receivables are collected 8.3 times a year based on the net credit sales of $29 million. A variation of this accounts receivable turnover ratio is called the average collection period in terms of days. We simply take the accounts receivable turnover ratio and divide it into the number of days in a year, 365. So 365 divided by 8.3 times the turnover ratio gives 44.1 average collection period in days. In that first example, I started with the extreme example of $29 million of credit sales and an average receivable of $29 million, giving a turnover ratio of only 1. 365 divided by 1 gave us our 365-day average collection period. Again, that's a very extreme case. You should be prepared to calculate turnover ratios and translating that into average collection periods per days. Now, what a company would do in looking at this information is they'd look at their normal terms of sale. If their normal terms of sale are net 30 days and it's taking them 44 days to collect their average receivables, they're not doing a very good job in collecting the receivables when due.